Hello, everyone. Welcome back to the channel. It's good to be here again. I've been quiet for a little while, partly life, partly work. But honestly, sometimes you need to step back, breathe, and really observe what's happening in the market. And more importantly, what's happening to investors. And today I want to talk to you about something that's been everywhere lately. YouTube, social media, Discord groups, comment sections filled with shock, frustration, even anger. People losing serious money. We're talking about the Harvest MicroStrategy Enhanced High Income ETF, MSTE. Now, before we go any further, let me be very clear. This is not financial advice. I'm not here to bash a fund, a strategy, or anyone who invested in it. I'm here to talk about why this happened, what many investors misunderstood, and, most importantly, how you can avoid repeating the same mistake. Because this story isn't really about MSTE, it's about something much deeper. You see, I've been working with American investors for many years now, retirees, young professionals, engineers, doctors, small business owners. Different backgrounds, different goals. But one thing is always the same. Everyone wants income. Everyone wants stability. And deep down, everyone wants to believe there's a smarter, easier way. Have you ever noticed how the most dangerous investments rarely look dangerous at first? They usually look attractive, comfortable, even logical, high income, monthly distributions, a familiar name, and on top of that, the word ETF. For many people, that word alone creates a sense of safety. A friend of mine once told me, if it's an ETF, it can't be that risky, right? And that's exactly where the trouble begins. Because MSTE isn't just an ETF. It's a single stock ETF built on MicroStrategy, a company deeply tied to Bitcoin, combined with covered calls and leverage. That's not diversification, that's concentration. And concentration, when things go wrong, has a very specific outcome. Losses don't whisper, they scream. Now let me ask you something, and be honest with yourself. Did you really understand what you were buying? Or did you understand what you were promised? Because those two things are not the same. A lot of people looked at the yield. They saw numbers north of 20%, even 30%. They saw monthly income hitting their account, and they thought, this is it. This is smart investing. But here's something I want you to understand deeply. Income does not exist in a vacuum. If your house is falling apart, it doesn't matter how much rent it generates. A 25% yield means nothing if your capital is quietly being erased underneath you. And that's what shocks so many investors. Not because markets went down, not because Bitcoin is volatile, we all know that, but because they assumed that covered calls would protect them. They assumed leverage would work in their favor. They assumed someone else had already done the hard thinking for them. Let me tell you something from experience. Covered calls are not magic, they are a tool. And like any tool, they work only in the right environment. When the underlying asset is extremely volatile, like MicroStrategy, covered calls can fail to cushion the downside. Sometimes they even amplify disappointment because the upside gets capped, while the downside does not ask for permission. This is where expectations collide with reality. And reality doesn't care how confident a YouTuber sounded. It doesn't care how many subscribers someone has. It doesn't care how beautiful the yield looks on paper. Markets respond only to structure, risk, and behavior. I've seen this pattern before, many times. People don't lose money because they're stupid. They lose money because they didn't slow down long enough to ask the uncomfortable questions. Do I truly understand the underlying asset? Am I okay holding this for 3 to 5 years, even if it gets ugly? And if this drops 40 or 50%, can I sleep at night? If the answer to any of those questions is, I'm not sure, then the investment is already telling you something. In today's video, I want to walk you through what actually went wrong, why so many smart people got caught off guard, and how to think more clearly the next time a high-income opportunity shows up in your feed. Not with fear, not with hype, but with perspective. Because in investing, just like in life, the goal isn't to chase excitement. The goal is to stay standing long enough to let time work in your favor. So take a breath. Stay with me. let's talk about what really happened. Let's slow this down for a moment, because when emotions are high, clarity disappears. I want you to imagine something simple. Imagine you're walking into a restaurant. The menu promises the spiciest dish in the house. Bold flavors, intense heat, unforgettable taste. It sounds exciting, but if you're not someone who tolerates spice well, that dish doesn't suddenly become safe just because the chef smiles at you. Investing works the same way. MSTE was never meant to be mild. It was designed to be aggressive. At its core, this fund does three things. It owns MicroStrategy stock. It sells covered calls on part of that position to generate income. And then it adds leverage, borrowing money to amplify the exposure. Each one of those elements carries risk on its own. When you combine all three, you don't get safety. You get intensity. Now here's where many investors went wrong. They saw the income. They focused on the monthly distributions. They heard the word ETF and assumed diversification. But MSTE isn't a basket of ideas. It's a bet, a very specific one. A bet that MicroStrategy will perform well, a bet that Bitcoin won't collapse for extended periods, a bet that option premiums will remain rich enough to support distributions, and a bet that leverage won't turn against you at the wrong time. That's not investing for most people. That's speculation, whether we like the word or not. I've had emails from viewers saying, but I thought covered calls were supposed to reduce risk. And they're right, in the right context. Covered calls work best on broad, diversified indexes with moderate volatility. They generate income while slightly dampening price swings. But when you apply that same strategy to a highly volatile single stock, the math changes. The cushion becomes thinner. The margin for error disappears. And when the underlying stock drops 50%, a covered call fund doesn't get to rewrite the rules. Losses still show up. Another thing that surprised a lot of people was the distribution cut. From the outside, it looks sudden, shocking, almost unfair. But from a structural perspective, it was predictable. Option income is not guaranteed. It depends on volatility, demand, and market conditions. When volatility dries up or moves in the wrong direction, income falls. And when the underlying asset is unstable, distributions become unstable too. This is why I always tell investors, income that swings wildly is not income. It's uncertainty disguised as cash flow. Now let's talk about something even more important, total return. This is where many people stop doing the math. Yes, MSTE paid distributions. Yes, some investors collected cash every month. But when you step back and look at the full picture, price decline plus income, the reality becomes uncomfortable. After several months, even with distributions included, many investors were still down double digits. So let me ask you a hard question. What's the point of earning income if you're slowly selling pieces of your own house to fund it? That's not income. That's liquidation. I want to share something personal here. I've invested in Bitcoin-related assets myself. I'm not anti-crypto, but I treat volatile assets with respect. I limit exposure. I size positions small, and I never confuse high potential with low risk. A risky asset can belong in a portfolio, but it must know its place. For me, that's usually 5%, sometimes less. When investors put 30, 40, 50% of their capital into something like MSTE, they're not managing risk, they're outsourcing hope. And hope is not a strategy. This brings me to the most uncomfortable truth of all. Many people didn't lose money because the fund failed. They lost money because they didn't understand what success and failure would look like before investing. They never asked, what happens if this drops 40%? Can I hold through that? Do I believe in this underlying business long term? If you don't want to own MicroStrategy for 5 years, you shouldn't own a fund built on MicroStrategy for 5 months. It really is that simple. The market didn't trick anyone here. It simply responded to structure and behavior. And this is where experience matters. In my years working with investors, the ones who survive and thrive aren't the ones chasing the highest yield. They're the ones who respect risk, demand clarity, and move slowly when everyone else is rushing. They understand that boring is often beautiful, because real wealth isn't built in moments of excitement. It's built by staying in the game long enough to let discipline compound. And that's the lesson I want you to take from this story. Not fear, not regret, but awareness. In the next part of this video, I want to show you how to think differently about covered call ETFs, how to evaluate them before you invest, and what questions you should always ask, no matter how attractive the opportunity looks, because the market will always offer you temptation. Your job is to decide whether it fits your life. Stay with me. So as we come to the end of this conversation, I want you to pause for a moment, not to judge yourself, not to regret past decisions, just to reflect. Because the market doesn't punish you for being wrong once. It punishes you for repeating the same mistake without learning from it. MSTE is not a villain. It's not a scam. And it's not a miracle either. It's simply a product designed for a very specific type of investor with a very high tolerance for volatility and drawdowns. The real issue was never the fund. The issue was expectation. Too many people walked into this investment thinking they were buying income, when in reality, they were buying risk. And there's nothing wrong with risk. As long as you recognize it, size it properly, and accept the consequences that come with it. But when risk is misunderstood, it becomes dangerous. I've said this many times to clients over the years, and I'll say it again here. The most important part of investing is not the return you hope for. It's the loss you are prepared to live with. If a 30% drawdown keeps you up at night, then a product that can drop 50% has no place in your portfolio. No matter how attractive the yield looks, this is why diversification matters. Not because it makes you rich faster, but because it keeps you alive in the game. And survival in investing is everything. A friend of mine once said something that stuck with me. Most people don't fail in the market because they lack intelligence. They fail because they lack a process. They react. They chase. They panic. They hope. But successful investors do something very boring. They observe, they wait, and they act deliberately. Before you put money into any fund, especially a new one, give it time. Watch it, study it, see how it behaves when markets are calm and when they're not. 6 months, a year. There is no prize for being first. The market will still be there tomorrow. And if you're already in a position that didn't turn out the way you expected, remember this. You don't have to fix everything today. Clarity comes before action. Understand what you own. Understand why you bought it, and then decide calmly whether it still belongs in your future. Because investing is not about proving you were right. It's about building a life where your money works quietly in the background, not one where it constantly demands your attention and your emotional energy. So here's the question I want to leave you with. Are your investments helping you sleep better at night, or are they keeping you awake? That answer tells you more than any yield chart ever will. If this video helped you see things more clearly, take a moment to reflect. And if you think someone else might benefit from this perspective, feel free to share it with them. And if you're interested in learning how to think about income investing the right way, with clarity, discipline, and long-term balance, consider subscribing, not for hot tips, not for hype, but for thoughtful conversations like this. Thank you for spending your time with me today. I appreciate you. And until next time, invest wisely, stay patient, and stay grounded.